Chapter 15, Taxes and Assessments. First type of tax we're going to look at concerning real property is property taxes. And here are some terms and considerations regarding property taxes. First, budgets and appropriations. Taxing bodies first prepare their budgets annually. In other words, this is going to be the money that's needed to provide the necessary services to that taxing body's citizens. In terms of appropriations, that same taxing body will list the different sources of funds. That's the appropriation process. One of the biggest sources of income for taxing bodies, local taxing bodies such as parishes, municipalities, special districts, is property tax money. We need to distinguish between an appraisal and an assessment. An appraisal occurs when a professional estimates the fair market value of a parcel of real estate. On the other hand, an assessment is the valuation of property for purposes of taxation. Sometimes the assessed value of a property in some areas is equal to its fair market value, or the assessment value in other areas is a percentage of the property's fair market value. In Louisiana, properties are assessed at 10% of their fair market value. And where we can find the information where what the assessed values of various properties are, we find them in each parish's assessment rolls. Property taxes are what we term ad valorem taxes. Those are taxes that are levied according to value. So the more valuable a property is, the more property taxes it will pay. Property taxes are a major source of income for local government, such as parishes, counties, cities, towns. It is those local governments that provide our services, and those governments pay for those services through property taxes, or that's a major source of income to provide those services. So in other words, an area that has lots of public service probably has a very high property tax rate. Property taxes provide income for local governments. There are no national property taxes. A tax district appraises all taxable property in its district. Taxes are usually quoted in terms of meals. 1 meal is equal to 1/10 of 1 cent or 1 penny of assessed value. So a meal is equal to 1/10 of a penny of assessed value. We could also quote tax rates as dollars per $100 of assessed value or dollars per $1,000 of assessed value. So let's look at an example of that on the next page. Let's say we own a property in a particular area and we are taxed by 3 districts: the school district, the city district, and the county district. The school district is collecting 40 meals. The city, 30 meals. The county, 10 meals. So a total of 80 meals are being assessed or levied on our property. If we want to quote that as dollars per $100 of assessed value, that would be $4 for every $100 of assessed value for the school district, $3 per $100 of assessed value for the city, and $1 for per assessed dollars per $100 of assessed value for the county. So in all, for every $100 of assessed value, we're paying $8 in property taxes. And we can also quote that as dollars per $1,000 of assessed value. So for our property, for every $1,000 of assessed value, we would have to pay $80 in property taxes. So in other words, as an example, if our assessed value of our property is $200,000, our tax bill would be $16,000. A property tax bill is a lien until it's paid. It is superior to all other liens, and it becomes a lien annually. And what happens if you don't pay your property taxes? That can result in the sale at public auction. What happens is that a buyer of your property would get a tax certificate. So suddenly, if you haven't paid your property taxes, the owner of the tax certificate is who you owe your property taxes to. After a certain amount of time, if you still haven't paid those taxes, well then the owner of the tax certificate can then foreclose on your property. In most areas, if you don't pay your property taxes and there is a sale at a public auction, the owner does have a chance to redeem himself. In Louisiana, it's 3 years. So if you don't pay your property taxes in Louisiana, your property will go up for sale at a public auction. Whoever buys the property gets a tax certificate. And you still owe the property taxes, except instead of owing them to your parish sheriff, you're going to owe it to whoever bought that tax certificate at auction. You would have 3 years to make payment of any unpaid property taxes and expenses along the way. If you don't, well then your property will be sold at auction. They'll foreclose. The owner of the tax certificate will foreclose on your property. What if you feel as though your assessment is out of sorts? If you feel you're being overtaxed in terms of your property taxes, you can appeal your assessment with the Assessment Appeals Board. But in the meantime, it does not forgive you from paying your property taxes. You have to continue to pay until your appeal is heard. And it's determined either it is fair or you need a reassessment. There are certain properties that are exempt from taxation. Government properties, churches, charitable hospitals, and cemeteries are all exempt from taxation. In Louisiana, we have several property tax exemptions. For instance, there's the homestead exemption, where the first $75,000 of fair market value on someone's principal residence is exempt from property taxes. Industry also has a property tax exemption. If they are granted the industrial tax exemption in the state of Louisiana, that means that this business is exempt from property taxes for a 10-year period. And the point of this is to entice various corporations to locate their operations here in Louisiana by forgiving their tax bill for 10 years. There are bound to be tax variations amongst properties. Usually, sales estimate the fair market value of a property. But sometimes some properties aren't sold on a regular basis. So assessors have to rely on mass appraisals, and that should occur every so often, possibly every 5 years or less. In some states, there's a board of equalization which attempts to equalize procedures between counties to make sure that all assessors within a state are correctly or fairly assessing properties. There's also what's known as a special assessment. That's when improvements benefit only a limited number of properties. Only those properties pay the special assessment. There are also some federal income tax benefits to owning real estate. And the first one we need to know about occurs when you sell your principal residence. We need to know about something called the basis. That's the price originally paid for the property plus any fees paid for closing and improvements. That's used in calculating income taxes. We have to make note, however, that when we say improvements, those are true capital improvements to the property. This does not include repairs or maintenance. So that allows us to calculate what's called a capital gain. The amount realized on a property is when you're selling your home, you're going to take the selling price and subtract out the selling expenses. That's the amount realized. So we find the amount realized by taking the selling price of your home, subtract out any selling expenses. From that, we are then going to subtract out the basis on your property. And then that leaves us with the gain on the sale, the capital gain on the sale. Previous slide, the gain was $42,500. So whether this person is a married couple or a single person, they would not have to pay any federal income taxes on that. When you do have to pay taxes, let's say you experience a capital gain on selling a principal residence that's greater than that exclusion of 500 grand for a married couple, 250 grand for a single person. These are the tax rates you're going to pay on that gain. Okay? Capital gain means that your property has appreciated in value, and you get this neat little exclusion as part of the code. In other words, it's preferential income tax. A preferential income tax treatment, and that's available to individuals. Now, also use the installment method, what we talked about in the previous chapter, to defer taxes. The capital gains taxes would be due as the payments are received. Remember that with an installment method, here the seller retains title, but the buyer is making payments rather than to a lender, making the payments directly to the seller in installments, and the buyer doesn't receive title until all the payments are made. With an installment method, it allows the seller to spread out the taxes, the capital gains taxes. They would only be due as the payments are received, so they would be spread out. Another interesting federal income tax treatment is that interest on a loan to buy a first or a second home is tax deductible. Only the interest is tax deductible on a loan to buy a first or second home. Now, the amount is capped at $750,000 worth of indebtedness. The Internal Revenue Code also provides for the deductibility of state and local real estate taxes. So in other words, your property taxes are deductible on your federal income tax returns, and that's up to a value or taxes up to $10,000. If someone that is not an American citizen owns property in the United States and sells that property, well then we have a federal law that governs that in terms of taxes. The Foreign Investment in Real Property Tax Act of 1980, or FIRPTA. It authorized the government to tax foreign persons on the sale, exchange, liquidation, redemption, gift, or transfer of a U.S. property interest. The person purchasing U.S. property from the foreign person, as well as any settlement agents, are required to withhold 15% of the amount realized. And the amount realized is equal to the cash paid, the fair market value of the other property that's transferred, and the amount of the liability assumed by the transferee to which the property is subject immediately before the transfer. And if they fail to withhold that tax amount, the withholding agent may be held liable for the tax. A foreign corporation that sells real property interests must withhold a tax equal to 35% of the gain it recognizes on the distribution to its shareholders. To realize that tax rules, especially federal tax rules, are continually changing for real estate. It has a high impact on real estate, supply, demand, value. There is certainly a need for frequent and detailed, updated information. It is the agent's liability to provide tax advice to the buyer and to the seller. They must be knowledgeable, they must be accurate. Now, some areas levy what's called a conveyance tax. In other words, a tax when property changes hands. In other words, there is a conveyance of title. Some states have a tax on this when property changes hands. In Louisiana, we do not have a conveyance tax. Once upon a time, there was a federal conveyance tax, but that ceased to exist about 50 or 60 years ago. Louisiana doesn't, some states, of course, still have a conveyance tax. Louisiana does not. Only New Orleans has a conveyance tax when property changes hands, and that is a flat fee in the city of New Orleans. Here's our terms at the end of chapter 15. Any questions? Don't hesitate to ask.